Good morning and welcome to Monday Musings. So today I'm going to be talking about what's going on with the Fed, which ties in perfectly because we are learning about monetary policy. So remember that the Fed operates independently from the government, and the Fed has a dual mandate to protect the validity, the strength, the solvency of the money supply, and also to maintain a target unemployment rate, which is also known as the natural rate of unemployment, which is about 4 to 5%, and we are under that right now. So what is the Fed doing? Well, in response to runaway inflation, which was caused by easy money policy. So let's go back and remember what we know about demand and supply. If there's too much of anything, then it goes down in value, right? So what happened during the whole COVID thing was the government was basically giving money away. So whether that was in the form of, they were sending out checks to people, the interest rates were at zero, so money was very cheap. So then there was more money chasing the same amount of goods. Therefore, the price of goods across the board went up. That's inflation. So that's where we are right now. Too much money chasing too few goods. We're also at a place where unemployment is very, very low. So if we look at the long run aggregate supply, we actually have less unemployment than we would like. So you could say, well, that doesn't sound right, because don't we want everyone to have jobs? Well, if everyone has a job, everyone has money, everyone is spending that money, therefore, again, the price of everything is going to go up. So we'd like to be at a happy medium. So about 4 to 5% unemployment is considered the natural rate of unemployment, and we're below that. We'd like inflation to be about 3%, which is also where we'd like to see the growth of money, and we are way over that. So what is the Fed doing? They are, in my opinion, moving really late, but they're starting to raise interest rates. So what is that going to do? That will lead to a tighter money market. That means that money will be more expensive. That means that people won't be buying as much. That means that people won't be producing as much. So that means that people will be laid off. So by tightening up the money market, that will directly lead to an increase in the unemployment rate. An increase in the unemployment rate coupled with a really tight money market could lead to a recession. And that's where we are right here. So Fed Chair Jerome Powell acknowledged that vanquishing inflation might tip the economy into a recession. And he says it's not the intended outcome, but it is a possibility. The number one priority is stabilizing prices. So that's monetary policy. So we are actually seeing it play out before our very eyes. So that's interesting. But then we also have the falling markets. So this is a result of consumer expectations. So the market hates uncertainty. If people, and I'm talking about all people, not just you and me, but also the people that run big companies, if people don't know what to expect in the future, that is uncertain, then they're very hesitant to invest or reinvest. And therefore, we see this crazy market situation. So that's going on. So what is the government doing to help us? Well, they're going to try to give us a tax holiday for gas. So this ties into excise taxes, which we have also learned about. So an excise tax is a tax that is built in to the price of something, so you don't ever know what the tax is. Cigarettes and gasoline and alcohol all have excise taxes. So it said that Biden is asking Congress to approve a suspension of federal gas taxes. So that would be 18 cents. So you didn't even know that every gallon of gas was taxed 18 cents. But that's just the federal gas. There is also state tax on top of that, and they're asking the state to take off theirs. So they're calling it a gas tax holiday. However, the bad thing is all those taxes are used for infrastructure. So one of Biden's key policy things was that we're going to fix infrastructure. If they give a tax holiday of 3 months, the government would lose $10 billion that would not go to infrastructure, and that could have a negative effect on the climate. So while taxes are high, one of the unintended consequences of high gas taxes has been that we are seeing some positive benefits to the climate. So that's just like an FYI. So we'll see, but interesting to note, is this simply a political maneuver on Biden's part? We're coming up on midterms, and the last time that we had a president think about doing this, it was Barack Obama, and he refused to do it. He said it was a gimmick that politicians use to curry political favor. And economists signed a statement opposing that at the time. But here we are, just a few short years later, looking at doing it again. Is it a coincidence that it's happening right before the midterms? I don't know. You tell me. So that is it for my Monday musing. If you have any questions or comments, let me know.